Getting ready to buy or sell a home in 30, 60, or 90 days? Then check out BundleSelect.com to find out how you could save 20% or more on your entire transaction. Save on real estate, lending, and title. With BundleSelect.com, technology and a personal concierge are at your service to save you time and money. Bundle Select's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling all of these services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. By bundling services like real estate, lending, and title, you could save tens of thousands of dollars. Act now, and this new model could save you money on your move, lower your interest rate, or cover your closing costs. Visit BundleSelect.com. That's BundleSelect.com.
The estimated minimum savings are based on a comparison with the national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker license number 004666902.
Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Kuchera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Kuchera.
Welcome in, Joe Kuchera with Real Estate Radio Live. Thank you again for joining us. For those who are on our live feed on Facebook, thank you for the feedback, the correspondence. We appreciate it very much. Just a reminder before I invite my guests in, you could tune in, listen to the podcast. The best way to download the podcast, you go to iTunes and just type in Real Estate Radio Live. Or you can always go to our website, RERL-1488.com. That's RERL-1488.com. We're with you at least 3 days a week with the podcast, depending on the schedule. If you'd like to reach me during the week, you could email joe at RERL-1488.com. Or you could always text or call 408-838-9060. Most of you know that for the last 7 years, the focus of the show has been education and information. We continue to do that by mainly having great guests like we have today. Why do we do that? To provide you, the consumer, with as much education information so that you make wise decisions in and around your real estate. Well, real estate is about what? Financing, money. And when we talk money, we talk Ron Howard, and Chris Cox is here with us today. Guys, good to have you back.
Always a treat, Joe.
Great to be here.
Good to have you guys with us. So Ron Howard's the managing principal, and Chris Cox of both of Siena Wealth Management. They're here on a regular basis. Today we're going to talk about market volatility, the price of having liquidity, and much more. So it's always good to have you guys here. I guess number one, before we get started, we're going to have a load of information to share with people, but maybe if each of you could take a minute and give your background and then your current roles and responsibilities with Siena Wealth, that'd be great.
Take the lead, Chris.
So Chris Cox with Siena Wealth Management, been working alongside Ron here for, 3.5, 4?
About 4 years.
About 4 years now, I think. Prior to that, worked in various aspects of the financial services industry, back office and working alongside other advisors, and really working right alongside with Ron, helping clients, working on financial plans, and just providing as much help as we can to these folks.
Very good. Yeah. Welcome back.
Thank you.
Mr. Howard, the superstar. Here we go.
Oh, hey, man. It's just a great life. Someone said, how long have you been in your career? I said, all my life, since college. So I love the investment arena and just really love helping clients. And that's we met with a client last week, and he goes, I'm ready to retire, Ron. Now make sure make sure I have enough money to last the rest of my life. I can do all my fun things. And I said, hey, that's our job, is to do that. So it's good. We enjoy
Very
it.
good. Well, good to have you guys here. Last time, a couple months ago, everything was just peachy keen, right? It was like
Joe,
this. I had you guys at the perfect time.
Perfect. We had right after the election back in 2016, and we had a roll last year.
All the love letters were coming in, and we loved it.
We'd have these little, softball questions like, "Hey, the market's going up. Why do we need? Why do we need you guys?" And
right.
And all of a sudden, we were here exactly 2 months ago.
Was it? Exactly. Okay.
Well, it was the 17th of January. And, of course, we had big gains in January.
Right.
I mean, it was up like 4 or 5%. Mm-hmm. And we were riding on that high, plus the big high we had and the big returns in 2017. Then all of a sudden, the 1st of February hit.
Yeah.
Remember that, Joe?
I do.
Yeah.
I do.
We're talking about a 1,000-point drop.
And it was, it's kind of interesting. Even myself, maybe I used to get a little bit more concerned about those before, but I don't seem to. I mean, even personally, I think it's just working alongside people like yourself and the reassurance and understanding that this is a long-term game. And this, certainly if you're getting ready to retire, then heck, you better have been, positioned a little different, right? It's a different story. So it depends.
You weren't ready to sell when the market declined by 1,000 points?
No, matter of fact, when it declined, I was ready to buy, right?
Okay. Hey, that's the right answer. That's good.
You are a smart investor. You know that? You must be listening to your friendly advisors here.
I am. No, it's true. But talk a little bit about, I guess it's a good place to start, why the volatility in that recent time period. And I know that then there was the tax, the big tax laws bills came out. In essence, there were some changes in that. So maybe we could start by giving us a summary of what your opinion is of why the volatility, or maybe it's just normal, and, we could start there.
Oh, it's normal. That's just, we hadn't had it for a couple of years, so it finally came about. What caused it? They talked about inflation, and that spooked. I think the day that Jerome Powell, who was the chairman of the Federal Reserve Board, was inaugurated, or was sworn in, was the day we had the 1,000 points. So who knows what it was? Someone said it was a mini crash, where a flash crash, where you had a bunch of computer programming that came into play that said, hey, we want to come back in and sell.
Okay.
And so as we talked about before, if you look at the market, if we have a chance, we'll talk about. You have all these shares of all these major companies, and every day only a very minute fraction gets sold. And yet that determines the price.
Right.
So if you have a bunch of sellers come in because someone needs liquidity, someone has a program algorithm that says, hey, we need to sell, then you see these big sales, and the people aren't buying right there because they don't have the cash in the market right there to buy. It takes a few days. So you see these big drops in a couple of days, and we saw that in February. And what happens, 3 or 4 or 5 days or a week later?
There we go.
Market goes back up.
While we do this, let me break in, because a couple times during the show, Ron's always been good enough. He's been on the show on and off for the last several years now, and each time he comes in and he's good enough to give out some books. So I'll show it for the benefit of the Facebook viewers here. The Wealth Solution, Bringing Structure to Your Financial Life. Ron wrote the forward in this. So anyone that wants to email, or call, actually either me or you'll get them a copy of that book. So I'll hold this up a couple times during the show, and then obviously for those that are listening to a podcast, what's the best way to reach you guys if they want this book or wants more information about your firm?
They can go to our website. It's very easy, sienawealth.com, SIENA wealth.com. Our phone numbers are there. Our number, though, if you want to call, is 408-244-3800. Again, 408-244-3800. And we had a client the other day, and they said, hey, Ron, what's a really good book that we could read about investments?
Okay.
Well, what book do you recommend? And so I'm kind of thinking in my head, and Chris goes,
yeah, what about the book we already gave you? What about the Wealth Solution?
Oh, yeah. I started that but didn't get very far. But it's actually a great book on investing. It talks about markets and risk and reward and how to plan, how to strategize, and then some of the details about investing, large company stocks, international, et cetera.
I think the also thing, to me anyway, it's simple to understand and read. Let's face it, there's some books that are loaded with graphs and charts, which are cool, right? But at the same time, sometimes you could get lost if I think the writer or the publisher is getting in maybe even some words or dialogue that just loses people, easy to lose them. So this, to me, is pretty simple.
So I'm going to go back to the liquidity.
Okay.
We go back to the market volatility. And when markets get choppy, people, want to sell. And so in our newsletter, we had this is our newsletter here. So if you want to get a copy of our newsletter,
there you
go. We have over here, volatile times, should we sell? Because when markets get choppy, people say, well, hey, the market's going down, maybe I should get down. And we talk about if you're going to sell, that becomes a timing issue. You're trying to time the market. You're trying to get out before the big downturn and then come back in. The downturn at the very bottom, come back in and catch the ride back up. The problem is you got to make two decisions. And as Chris talks about, you got to know when to come out and when to come back in. And most people don't do that very well.
Yeah, most folks just aren't picking either one of those correctly, let alone being right on both times. And often people will point to pundits or people that are on TV, you know,
Right.
the talking heads, and say, oh, well, he nailed it, right? Or this guy was just right. So, well, if you go back and look, he's been saying that same thing for the last 3 years, right?
Yeah.
And even a broken clock is right twice a day. So, you know, he's bound to get lucky eventually. That's kind
I
of
like that line. I never heard that one before.
Oh yeah, and then to really kind of carry on that, what Chris has talked about, we had a client been with us for years and years. About 4 or 5 years ago, said, "Hey, we're still kind of coming out of the 2008 scenario. He's concerned about Greece. He's concerned about Europe, and he says, "Hey, Europe's going to collapse with all this debt. The market's going to go down 3,000 more points down. We're at 12,000 on the Dow. I'm going to go to all cash." And I said, well, you know, you're trying to time the market now. You want to go to cash. I said, that's insanity. I said, you know, you're going to wait for the market to go down. It may never go down because you don't know that it's going to. So I remember we convinced him to go half cash and half stay in the market. And that was in June of 2012. The market never went down. It marched from 12,000 on the Dow to 24,005 where we are right now. And so we finally got him back in probably around 16,000 on the Dow. But, you know, you have this greatest rationale about your concerns about, and Europe was having problems. So you could really make that case, but it didn't happen.
Yeah. No, it's a difficult one. And I know that it is difficult because, you know, we live in a generation where people want things fast, quick, and easy. And this is a perfect example of something you have to not look at the technical age that we're used to things, right? Get on Amazon, order something so it's here 24 hours later, 12 hours or whatever it is. Drop it in a what do they call them, the drones. But
or the locker box downtown San Jose, you can pick it up down there.
But truly, this is something still in our life that we have to plan, be diligent, and then prepare, and also revisit with someone like yourself, right? Talk about the philosophy of your firm. It's probably a good segue to how you guys work with your clients, the plans, how you put them together, how often do you meet, all that.
Yeah, we have a big whole philosophy built around design, build, and protect. So you want to design your plan, customize. We want to build it, you know, the allocation, how we do it, and then protect it.
Right.
And that's through diversification. We meet, you know, for a newer client, we meet every 3 or 4 months. Clients have been with us for years and years, typically twice a year.
Right.
But it's always coming back to review where they are, you know, where they're heading to. If they're not retired, how soon? If they are retired, making sure their money outlasts them.
Right.
Stress test the allocation, the portfolio, making sure they're doing just the right amount.
You know what I wanted to ask you guys too, if any, what are any adjustments, new conversations you're having based on the new tax bills? Is there anything that you feel like, oh gosh, you know, we need to talk to our clients because of some of the new tax changes? Does that affect any of their strategy and planning?
Well, not a strategy, but I had one client the other day because, you know, even though we've had clients for years, most of them still don't put enough away.
Sure.
So we were talking back and forth. What should we do about our allocation? I said, well, let's talk about the Tax Reform Act. I said, did you get a little more in your paycheck? Oh, yeah, I got some more money in my paycheck. I didn't know where that came from. Right. I said, well, that money should go into your investment account.
There you go.
So we said, you need to invest more. So whatever tax savings you were, don't go out and buy something. Go out and invest the money. So that's one thing, because not all, but most of us will pay less taxes. And that'll translate back into a payroll. You'll get a little bit more on your payroll. And I'll just put that into your investments. In terms of other strategies, it's really getting more customized around, you know, do you want to do a donor-advised fund because of charitable contributions? Because now you have a $24,000 standard deduction. So you got to overcome that. So there's some little nuances in the tax bill that you may want to look at. Yeah. That would be helpful.
The other thing, if you guys could speak to a little bit that I'm interested in, you know, this Bay Area, of course, we've seen what the housing market's doing and the appreciation. It's just crazy. Again, if we own property for a while, we're geniuses. I laugh at not only this market, you know, the investments and also real estate. You know, all of us, some of us, people think they have something to do with it, right? Real estate goes like this.
That's right, straight up.
It's like, no. We don't have anything to do with it. We're just lucky or fortunate. But to that point, what I'm hearing and kind of seeing and feeling, I'm wondering if you give us some feedback from your clients. You know, some people are like, man, I get $2 million of equity in my home, but if I sell, I got to take this huge tax hit. Then what am I going to do? And do I really want to give the government that kind of money? Or are you having these kinds of conversations with clients, or how are you seeing that now that this appreciation just keeps ticking up?
Yeah, and then the thing that as a tag-along part of that conversation, if you're going to stay in the Bay Area, what are you going to buy?
Right. Right.
So you can sell your big home and downsize, but then you look at capital gains.
Mm-hmm.
The small units are still expensive.
Yeah.
So you look at that whole aspect there. So yeah, and then the other big thing is the Prop 13 taxes.
Right.
I mean, so I have some clients that I won't tell you what they pay every year in taxes, because it's like, wow, compared to their next door neighbor who just bought the house 2 or 3 years ago. So a lot of people are just staying put.
Right.
And not to be morbid, but if you can say, hey, let's stay put until one of you passed away. And then you get step-up basis.
Yeah.
And so that's huge. So if you have someone who bought a home in Los Gatos for $100,000 and now it's worth $2.5 million or $3 million, that's a huge capital gain. You're talking about $500,000-$600,000 of capital gains tax to the government. So you hang on. And if they can't afford it, we've talked about reverse mortgages. So you could do that to kind of make sure you can keep your retirement going on, and that gives you the chance to move out further down until one of you passed away.
All right, very good. What are your thoughts on, maybe you could share with the audience a little bit about 401ks? Should you always max them no matter what? Are they always good no matter what with your employer? And then, there's a lot of talk about the Roth too. So maybe if you guys could touch on both of those from the listeners here.
Yeah, certainly. So as far as the 401ks go, the first things first, if your employer is going to match,
sure, that's
take
correct.
full advantage of that, right? Because that's an instant double of your money, and that's the best return you're going to get.
Okay.
So, 99 times out of 100, we advise our clients to always get that match.
Okay.
Beyond that, it depends on means and some other things, right? But sure, if you've got the means and the income and excess income, then by all means, load up your 401k. For a Roth, that's a great thing, especially for younger folks, because as you get older, especially around here, you just don't qualify. You make too much money, so you're not able to fund a Roth.
Right.
But especially when you're younger, you got a lower income. Taxes are a little bit less of an issue, so you don't need the write-off. Go ahead and fund a Roth as much as you can.
Okay.
And we've even, with some of our wealthier clients that do have a lot of money, that just want to put more money away, you fund an after-tax IRA, right? So it's not qualified. You don't get the write-off, and then you just convert that to a Roth IRA instantly, kind of immediately. So you don't have any taxable gains in there, and now you're still funding a Roth IRA, which is where they, ideally want the money anyhow. So
and every year,
every year, and that's another avenue to put some of that money away. Yeah.
Let me add one thing, because we do believe in maxing out 401ks and helping out, but you don't want to get to retirement to where all your money is either IRA or 401k.
Okay.
Because when you start taking money out, it's all ordinary income. If you need money ahead of time, it's hard to get it out of an IRA. There's some ways to get it out of there. So I always recommend have your trust account or joint account, and you start building that. It's more flexible. It has cost basis stepped up if somebody passed away. It's more liquid. You can do a margin account. You can margin against that if you need to have some short-term needs for cash. So I always encourage your joint.
Okay, very
joint
good.
Or trust.
All right, here's what we're going to do. We're going to take a quick break. I'm here today in studio with Ron Howard and also Chris Cox. They're both with Siena Wealth Management. We're talking about investment, the volatility in the market, and much, much more. Stick with us. For those on Facebook, we're going to take a quick break, and we'll be back with you in just about a minute.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com.
Getting ready to buy or sell a home in 30, 60, or 90 days? Then check out bundleselect.com to find out how you could save 20% or more on your entire transaction. Save on real estate, lending, and title. With bundleselect.com, technology and a personal concierge are at your service to save you time and money. Bundle Select's hand-picked team of experts will compete for your business, so you'll save thousands of dollars by bundling all of these services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. By bundling services like real estate, lending, and title, you could save tens of thousands of dollars. Act now, and this new model could save you money on your move, lower your interest rate, or cover your closing costs. Visit BundleSelect.com. That's BundleSelect.com.
The estimated minimum savings are based on a comparison with the national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker license number 004666902.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live as we continue through the show. In the studio today, we have Ron Howard and Chris Cox, both with Siena Wealth Management. We're talking about market volatility, the kind of stock market in general, investment strategies, and now we're going to chat a little bit about liquidity in a couple of different senses. Before we do that, one more time, I want to make sure I do this. So Ron is always kind enough to give out the book when he comes to visit us, The Wealth Solution, Bringing Structure to Your Financial Life. It's a simple read, and he wrote the foreword. So if you want a book, a copy of the book, Ron has been kind enough to pass that along and share it to you. But we do need to know where you live or an email or something in order for us to do that, right? So they could contact you or me. Again, the best place to reach you guys would be what, website and phone number?
Yep. Website is sienawealth.com, SIENA, just one N, wealth.com, 408-244-3800.
Very good. So you're going to talk a little bit about what, liquidity?
Because when we talk about market volatility and we see these big swings in the market, that's the price that stockholders have for liquidity. Okay. Because we can sell a stock any day. If you compare that to real estate, you can't. Mm-hmm. You know, you're going to put your house up for sale. You're going to have offers coming in. You're going to decide when you're going to sell it, who's going to buy it, you know, and the price and so forth. So when we have these big swings in the market, it's people say, well, hey, the market's all fraught with either problems, it's dysfunctional, it is not working properly, there's something going wrong. In reality, it's just buyers and sellers coming together at an auction. Mm-hmm. And so if you have more sellers than you have buyers, the price comes down. Right. And sometimes it comes down big time if you have a lot more stock that comes on the market to sell than you have buyers. Mm-hmm. Then the buyers come back in and then the price goes back up. So, but we want liquidity in stocks. Mm-hmm. If you don't want liquidity, then you end up getting longer-term instruments, CDs, annuities, and so forth, but people want liquidity. And with that, you have that volatility. So our long-term clients have to understand that in order to get these great returns over periods of time, you have to go through these market swings because we want liquidity. Right.
Yeah, very good.
Well, the other thing I was going to say is that liquidity means we have a price instantaneously on the stock or the value of that stock. On your home, though, you don't really have a daily read of your home value. You don't have next to your address when you drive up in the driveway, okay, my home value is priced at this today. Yeah. And it's a little ticker tape up there or a digital screen.
That's
so
true.
You don't have that. So it's a different hold than owning real estate. You've got to have some cash flow to hold off the tough times. Right. You know, you've got to have some money to, you know, if you need to improve it and fix it. So it's a different game, but for liquidity, we pay this price of volatility to have liquidity.
Yeah. What I want to talk to you guys a little bit about now is the importance of planning, and then what you said earlier a little bit, you know, getting ready for retirement. It used to be, remember, not too long ago, everybody would talk about the critical mass was $1 million. Once you get to $1 million, you're good to go. And, you know, oh, my gosh, that was maybe
not anymore.
Maybe in Waterloo, Iowa, right? Or something like that. So I know it's individual, but how do you gauge and take a person through that path or that, you know, when they say, okay, 20 years from now, I'm going to need, you know, this amount of money, and with the cost of living and insurance, my gosh, there's so much that has to go into that.
Yeah, it's all a function of budget. Chris runs a lot of numbers, and so it's really, you know, do you have your home paid for or not? Are you more frugal, or do you like to spend lots of money? So, I mean, there's all these different scenarios, and so you could put together a plan that if you have $1 million plus you're collecting Social Security, you know, not necessarily here in the Bay Area, but you could probably survive okay.
Good point.
If you're in the Bay Area, hey, I'm talking $2.5-3 million as a minimum, and I got some clients it's going to be $10 million.
Yeah, because of the lifestyle, what
they're doing and what they've got, and expenses and so forth. And so I don't know what you found, Chris.
Yeah, you know, definitely $1 million is not what it used to be.
No, it's sad, but it's true.
Yeah. As a matter of fact, the other day, one of our clients said, hey, you know, when did becoming a millionaire not really mean anything? Right? It's like, well, I mean,
welcome to the Silicon Valley.
And he wasn't even here. I think he was in Montana. So, you know, that should tell you something there. Right. But, you know, Ron kind of touched on the design, build, protect model that we work with. And we design and build these plans in conjunction with our clients and kind of bring our expertise and their life together and try to build something that will work, get them to their goals. But really it comes down to the protect, right? That's where we spend most of our time. Yeah. And, it's funny, you would think that protect means, oh, well, what do? You buy some insurance or you do this or that. No, really what we do is we protect your investments from the client, right? From making poor decisions. I see. For instance, we have the Dow Bar study here, and this is a study that the industry has done for a long time now, and goes back 20 years. So in 2015, a 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was only 4.67, right? Wow. So you think about that. That's a gap of 3.5%. And why is that the case? Well, it's because they keep trying to make changes and do things and make it better when really, the market's going to do what it does, right. and you have to kind of trust it and sit back and let it ride, not try to make it faster, make it better, make it stronger. That's not, that's not how it works. So a lot of our time is spent just kind of talking our clients down off a ledge sometimes, right. or saying, hey, you got to be a little bit more aggressive, or you got to pull it back, or whatever it is. But
tie their hands behind their back.
Sometimes
just sit there and be still and let the market take care of it.
Sometimes, yeah. And Ron takes the bulk of those calls, so I'm thankful for that. But that's the key.
But the other thing along with that, whether your goal is $1 million or $2 or $3 million. I think it's really important in terms of mindset. And if you look at all of our clients, and we have a whole broad array of backgrounds, professions, it's across the board. But someone said, well, who do you best serve? Okay. And if you go through all of our clients, you'll find that there's one key word, and that's they're frugal. They could be earn $1 million a year plus, and their DNA is they're still frugal. They're thoughtful about what they spend. They don't always buy brand new toys, and they start learning to set money aside.
So that's a really good point.
It's being frugal.
No, that's a good point. Yeah. So maybe spend a little bit more time on that, because I think there's a big truth to that. So many people, they start making a little bit more. I mean, I remember a while back until all of a sudden you make a little bit more, so you think, oh, gee, or I could spend a little bit more. Next thing you know, it's all relative. So that is a really good point. It's really becoming. It's more about not so much what they always say now, how much you make, but what you save or keep, right?
Yeah, that's exactly right.
So spending habits is a big deal.
If you can be frugal, which means you save more, right. But you also don't spend, and you're very thoughtful about spending. I have all kinds of great stories, but I won't take the time on the radio show about people that are wealthy clients. They're not going to turn the heat up to more than 68 degrees.
And they're clipping coupons.
They don't want to pay PG. You're never going to spend all your money to enjoy life a little bit. So we have those conversations, but it's just part of that DNA of just being thoughtful and not just spending for the next newest item.
Yeah. One of the other things that I always like to share with the audience, because the question comes up, how the different firms work. How do you guys work? Maybe you could talk to a little bit about the different structures, fee-based. Do you charge on the funds, the management fee, all these? There's a lot of different models I know out there. Maybe you guys could explain how you guys work, and then maybe as a general rule, kind of the industry, when people are trying to really do some research and figure that out, who the right fit is.
Yeah, there's
different models.
Yeah, there's different models, and there's two major models, but they kind of get melded a little bit. Okay. There's the commission model, which is the big, we call them wirehouses, the big investment firms. Those are more commission driven. Sometimes they do get involved in fee based, but there's no fiduciary responsibility. It's all about are they
suitability.
Suitability, yes. Yeah. So they're suitable.
You have your attorney next to you.
Yeah, my attorney. Suitability here. So on the other hand, there's investment advisors that are fee based, like we are, that have fiduciary responsibility. There's been a big debate back with the SEC about, are you a fiduciary or a non-fiduciary? So we are a fiduciary, which means we have to put our clients' interests first and foremost above ours. Right. But because we're on the same side of the table as the investor, because we're concerned about them, we get paid on their assets that we manage for them. It's a great win-win. So that's what really encourages, you want to work with someone who has your best interests, who's bound by that fiduciary responsibility of making sure we put them first and foremost. So that's how you want to look at it. And there's other models out there, but those are the two, commissioned or fee-based, and sometimes there's a blend between the two.
You guys, if you're speaking to the famous millennial now that we hear about all the time, what would be the best advice as they're listening to this podcast or watching us on Facebook? They're starting right now and they're thinking, God, I really need to start now, because that's what we all know, that the sooner the better, right? I mean, we all would attest to that. So what advice would you give them that are just starting out, some of the strategies other than just save, obviously is one, but is there a percentage or certain things you'd like to see someone do, as early as possible? Maybe walk us through that.
Well, it's a handful of the things we've already touched on, right?
Okay.
So first off, as a millennial, hey, if you've probably got a job somewhere out of college, and there's probably a 401k plan, and there's probably a match, so go ahead and take advantage of that, right? Fully fund a Roth IRA while you can. Okay. And then it comes back around to the lifestyle creep, right? Don't let your lifestyle creep up too quickly. Stay in that cheap apartment, a little bit longer than you want, right? Drive your old car that your parents gave you for a little bit longer, and make sure you're not just spending the money because you have it, right? Get excited about seeing your bank account grow, not just about buying the next thing or going clubbing or whatever it is, right? Try and make sure that you're building for the long term, and you've got to keep your lifestyle in check, so that you can, your wealth can kind of grow as well.
Very good.
One thing that Chris always, for some clients, talks about is the HSA, your health savings account.
Health savings account.
Health savings account is deductible if you qualify. You have to have a, what do they call it? A
high deductible. Health insurance plan.
Insurance plan. Yeah. But you can put away, depending on whether you're single or married or family, you can put up to, I think it's almost $7,000, $8,000, and it's tax deductible. And you can set it aside. If you don't use it for health, you can be used at 65 when you retire. That's great. Like an IRA.
Yep. We have just a couple minutes left. Anything you guys want to leave us with your parting wisdom? Because we'll be about another 60 days before you come back, I guess, before we get you back on the calendar. As people sit here today, what kind of thoughts do you have for them?
Well, there's always going to be a crisis. Something's going to happen, whether it's the dot-com crisis, the 2008 real estate crisis. Something. There's always something. And I don't have time to go through this whole chart. We put together a chart for our clients. It's the market's response to a crisis. We go back to 87 with Black Monday.
Okay.
Remember Black Monday?
Oh, yeah, I do.
That was when the Dow dropped 25% in one day. That would be like an 8,000-point drop on the Dow today. But in one day it dropped 25. It was only 500 points, but that equaled to 23% of the value of the Dow in one day. And this chart goes through and says, okay, what happened in 1 year later, 3 years later, and 5 years later?
That's a great chart.
So you see that 1 year later, after the 1997 Black Monday, it was up 19% in 1 year, 33% gain after 3 years, and 76% gain after 5 years.
Wow.
So it talks about these crises we have back, the savings and loan crisis. We have the Russian crisis back in 1998. We had the dot-com in 2000. We had the terrorist attack in 2001, and then we have the bankruptcy of Lehman Brothers and the subprime lending. And all this shows that within 5 years, you're up anywhere from 47 to 81%.
Yeah. So the message: stay in the market, don't panic. Right, dollar cost, all those good things.
That's right.
Keep it going.
Yep. Keep investing. Keep investing.
As you say, keep on.
Keep it on.
Keep it on.
There you go. All right, you guys. Thanks for coming in today. I really appreciate it. This is Joe Kuchera with Real Estate Radio Live. Thanks for joining us again, Ron and Chris. Always a pleasure to have you in the studio. We'll have you back in a couple of months. Remember, for more information, you can always go to RERadiolive.com. Thank you. Take care. Have a good day.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.